So, hello everyone, and welcome to the Blockchain Community Day 2024 conference. And I'm your host, Sergei Konstantinov, and today we are delving into the fascinating topic of the flow of money 2030. And we are honored to have with us today Yagnesh Pota, our esteemed guest, whom I now invite to join us on the virtual stage. Welcome, Yagnesh. Thank you for gracing us with your presence today. And could you please share a few words of welcome and provide a brief introduction of yourself?
Hi, good morning, good evening, good afternoon, wherever you are in the world. My name is Yagnesh Pota, and I'm based out of Singapore. And I have been in the technology industry with investment banking for the last 20 plus years, having worked with all of the large major investment banks. And more recently, over the last 7, 8 years, I have been involved in blockchain related initiatives when I was at ANZ. And I became an evangelist for digital assets and currencies and how they will impact capital markets and financial systems over the next few years. The Flow of Money 2030 is actually the title of a book I've written. And so this talk is going to be inspired by some of the content in the book.
Well, thank you very much, Yagnesh. Well, before we proceed, a quick reminder to our audience. Well, please post your questions in the chat throughout the presentation, and we will address them at the conclusion of our talk. And well, we are now ready to begin. Best of luck, Ignesh. The stage
Thank you.
is all yours.
Okay, I hope everybody can see my slide. I've already introduced myself, so we'll move on. The topics that I will cover include a fairly wide variety, but the key focus is going to be around how money is changing, why it is changing, some of the categorization considerations, evolution to Web3, and how blockchain is starting to impact the way money flows these days. Okay, and so I have purposely not numbered these topics because I don't believe there is a hierarchical flow to these. It is all very heavily interconnected, as you will see from my presentation. Moving on. So, evolution of money. Where are we today? Retail, commercial, institutional, SME banks continue to play a central role in the control and distribution of money. Hence, they control the creation, lending, and access to money. And over a period of time, they have invested in large monolithic systems or banking platforms that are pretty much now considered legacy. In some instances, these platforms are over 30 to 40 years old, and these are core banking platforms. Also, central banks and banking intermediaries have created centralized networks, closed off networks, which essentially impacts the financial system by limiting flexibility and growth. You can see in the diagram where if you want to do an FX transaction, you have to go through a number of banks and SWIFT. And so there isn't a formal way of doing commercial FX transactions today and in the past without involving intermediary and correspondent banks. And as a result of this, all of this creates a closed world of system resulting in the banked and the unbanked over the last few decades. So, what has changed? Um, Essentially, we've had the advent of new technologies. Decentralized technologies like blockchain are offering an alternative to the centralized control of money by banks and governments. DLT technologies enable a more transparent and distributed system where transactions are recorded on a public ledger and the network is maintained by a decentralized network of participants rather than a single authority. And this also reduces or basically removes the middleman, i.e., the intermediary. Also, we now have various organizations thinking about new models of classifying money based on technology and use. So a good example is the Bank for International Settlements has developed the money flower framework to categorize different forms of money, including central bank digital currencies, cryptocurrencies, and traditional fiat currencies. This framework helps to understand the evolving landscape of money in its various forms. Interestingly, there is a diagram on the right for Industry 4.0. And if you look at that diagram, what is the one thing that's missing from that diagram? It doesn't take into account the impact of blockchain or DLT or distributed ledger technologies on the industrial landscape and different industries. And I think that diagram needs to be revised to become 4.0A or 4.0B or whatever, because I think AI is also going to have a greater impact than anybody had anticipated. Moving on, let's look at the BIS money flower. I am a big fan of this model because it uh, basically shows you in a single diagram all of the different categorizations of money. So essentially, the BIS money flower is a blueprint for categorizing currencies based on four fundamental properties: issuer, form, accessibility, and technology. And you'll see I've put technology in red, and there is a reason for that. The digital aspect is basically the blue petal with the word digital on it. And let's take a few examples of the technology shifts that are happening. So let's talk about traditional bank deposits. The technology is typically a centralized system maintained by the bank. Transaction data is stored in proprietary databases, and of course, it's a closed off network. You have to have an account and belong to the bank to get access to your money. Central bank reserves and settlement accounts, again, centralized systems overseen by central banks, often involving connectivity with real time gross settlements systems to do FX transactions, etc. But again, a fairly closed network. The banks have to be under the regulation of the central bank in the first place to use those facilities. Now, with central bank digital currencies for wholesale circulation, there is a shift. So, the central bank may employ uh, distributed ledger technologies for secure, efficient transactions amongst banks, or use centralized systems akin to present day digital transaction methods. Then we come to cryptocurrencies on permissioned DLT, where the issuer is often a consortium or a specific organization. Here, the technology is a permissioned distributed ledger or blockchain where network participation is gated, ensuring greater control over the consensus process and transaction validation. When we come to cryptocurrencies on permissionless distributed ledgers, such as Ethereum and Bitcoin, the uh, cryptocurrency uses permissionless distributed ledger or blockchain, ensuring full decentralization, offers a trustless system where network security and integrity are maintained by cryptographic means and consensus algorithms. So you can see, depending on whilst the banks give you access to your bank deposits through the web, it's not necessarily uh, what we what I would call digitalized, right? It's just another channel. But you can see the transition in technology from centralized systems to distributed networks and distributed ledger technology. Moving on. So, blockchain and distributed ledger technologies have effectively created new tools and that allow us to look at the new money. So, what are the tools of new money? We have cryptocurrencies, the evolution of Web3, tokenization and tokenomics, decentralized finance, otherwise known as DeFi, digital wallets, and digital exchanges. And I will go into a lot more detail about how all this hangs together, right? So, how does everything come together? So, the technologies described below allow people to create better systems aiming to introduce more equality, democratization of wealth creation, and real alternatives to traditional long-standing debt-based banking and money systems. And so what you have here is basically blockchain becoming a foundational piece that enables cryptos and Web3. Web3 fuels innovation in a number of areas such as DApps, digital wallets, and digital exchanges. Cryptos and Web3 allowed tokenization to proliferate, and tokens could be held in digital wallets and traded through digital exchanges, and DApps provided a user experience. Proliferation of tokenization has now created new digital assets from traditional real world assets and currencies. And that in turn has helped to drive decentralized finance. And decentralized finance in turn is done through Web3 and fuels Web3. So hopefully this gives you an idea of how the uh, different components come together to create an entire ecosystem. The boxes that are in green, Web3 tokenization in DeFi, I'm going to go into a little bit more detail now. So what is Web3? How did we evolve to Web3? Essentially, Web 1 was the static web, uh, basically a digital monument or statue where we pulled data through the internet. Web 2 became the social web. Think of it as a dynamic city center where we pushed and pulled data and we shared uh, information about ourselves, and we shared social updates on that web, and that allowed the, the creation and increase of what I call platform-based e-commerce, such as Airbnb, Uber, etc. Web 3, I call the semantic web. Basically, think of it as a decentralized metropolis. Web 3 represents the transition, and in this era, the internet has become a place where humans and machines can understand and interact with information, and essentially um, the emphasis is on centralized data storage, peer-to-peer interactions, and creating a digital ecosystem that resembles a sustainable, self-sufficient city. On the right-hand side, you can see a diagram where Web 1 was technically valued at 1.1 trillion. Web 2 has been valued at about 5.9 trillion. Web 3, I think, is going to surprise everybody. And the adoption of Web3 technologies and what it does for decentralized finance is going to rewrite the history books. So, what are the elements of Web3? Starting at the bottom, you have trusted data through blockchain and distributed ledgers. Then you have relationships through wallets and decentralized identities. And commerce happens through exchanges, DApps, and smart contracts. This is all held together through peer-to-peer networks and distributed autonomous organizations. And then the user experience is through client front-end apps, and in some cases, organizations have tried metaverse. Okay. Moving on, we come to the tokenization process. Now, this is quite important. And this is what, if you are a Michael Bay filmmaker follower, this is the money slide. Okay. Tokenization and tokenomics. So, tokenization is the process of converting rights to an asset into a digital token on a blockchain. This allows for the fractionalization, programmability, and tradability of previously illiquid or indivisible assets. Tokenomics is a term that refers to the study and analysis of the economic aspects of cryptocurrency or a blockchain project, with a particular focus on the design and distribution of its native digital tokens. So let's take a scenario where you have a portfolio manager, and the portfolio on the left side, you have the portfolio manager. The portfolio manager decides on asset allocation and selection, and sources assets through market makers and liquidity providers. The assets are then put through a tokenization engine and converted into tokens. And you will see that the tokenization engine is actually creating a golden record of creation, ownership of assets, and asset-backed tokens on a blockchain. So you've got the public blockchain at the bottom, and the technology stack is a smart contract layer and a blockchain layer. Now, the whole idea of the tokenization is to create a digital money market fund, and this fund is created based on a certain risk profile. So here we have, for example, moderate risk. And so that means that the kind of assets that the portfolio manager will look to tokenize is cash, technology stock, developed markets, ETFs, fixed incomes, fixed income such as bonds, etc. And they're going to get converted into tokens, and a fund is going to be built. So in the bottom box, you can see underlying tokens, and you can see how the different asset class tokens make up that money market fund. So, for example, cash is 10%, repos is 20%, 2-year European bond is 40%. Once this money market fund is created, you now have to provide asset servicing for payments of corporate actions, automated rebalancing, settlements via CBDCs or through other tokens. Now, this is called asset servicing. And once you have that piece put together, you now basically have an entire tokenization platform. And so what happens is you now open up and provide access, 24/7 access via distribution platforms and digital exchanges. So this is where things like Bitcoin ETFs has gone through the similar process, right? Where you can now basically buy Bitcoin, participate in Bitcoin ownership through an ETF, through BlackRock, Fidelity Investments, etc. And once these tokens are bought, you then have to provide for some sort of a digital asset custodianship as part of the asset servicing. So you need some sort of a platform or a wallet that then contains your digital assets, or a record of your digital assets as to where they're located and what you own. So this is quite important because this is going to become a key. This is already happening in the financial markets today. Okay, so who are the key players influencing the technology decisions? Essentially, big banks like JP Morgan Chase, Bank of New York Mellon, Citi have now started seeing that they're going to get left behind if they don't start taking part, right? And so they have done this through acquisitions and funding. And why are they so interested? So Citibank has valued the new asset classes that tokenization will create at US $10 trillion by 2030. JP Morgan and Bain have valued new alternative investment opportunities due to tokenization at 400 billion by 2030. And it is estimated that 5 to 10% of all assets globally will be tokenized by 2030. Okay, so the diagram here is showing you current blockchain projects, and you can see that the participants can tend to be investments, banking, government, payments, insurance, trade finance. And at the top side, you can see all the different areas such as asset tokenization, CBDCs, cross-border payments, FX, payment processing. So all of these areas are going to be affected, and there's going to be technology transformation in how we do all of these activities. And so within each of these areas, you can see the key players. And of course, you will see that you have the likes of JPMC, HSBC, Santander, UBS, all mentioned here with the different fintech providers. And of course, finally, you have governments who are interested because they want to be able to connect and benefit from the proliferation of these new technologies, primarily in the form of CBDCs and primarily in the areas of cross-border payments and effects, and essentially RegTech. Okay, moving on. So how does this affect an individual? So what we're going to see is enhanced utility and interoperability of an individual's assets. Today you have fragmented accounts, manual processes, paper-based documents and files. So you have checking accounts, current accounts, saving accounts, brokerage accounts, mortgages. All of these things are going to get tokenized. And so in a cryptographically protected blockchain-based programmable wallet, your current account, savings account will be represented, will hold CBDCs, cryptos, and stablecoins. Your brokerage accounts, investment accounts will become tokenized securities and assets. Mortgages and loans, credit cards, lines of credits will become tokenized obligations, and titles and insurance policies will become timed tokenized obligations. So the future is, in the future, you will have a single wallet with tokenized assets and secured documents in interoperable wrappers, and you will have interoperability between different types of wallets that suit your needs. Real world examples of tokenization of assets include real estate. So HKMA and Ripple did a POC of tokenizing REITs in Hong Kong. This was the first test of the Hong Kong dollar. A number of banks have already started doing primary bond issuance on blockchains and using smart contracts for coupon payments. HSBC has recently launched a gold token, which is basically a digital token that represents ownership in HSBC's gold deposits and gives you fractional ownership of the physical gold. So each token represents 0.001 troy ounce of gold. A big area where tokenization is going to play a major role is tokenized carbon credits, which can be representations of off-chain value carbon units or native digital carbon credits. And so basically, once you get your carbon certificates, you are able to convert them into carbon units, and that will be stored on blockchain and then can be tokenized and traded. We are already seeing payments in stable coins through digital tokens. And essentially, there are a number of fintechs and banks working to enable real-time payments and settlements. So, for example, JPM Coin, Onyx Network, the USDC Tether stable coin are just some examples. Finally, so what does this all mean? What does a next-gen banking system look like? Because after all, at the beginning, I promised to show you what will be the impact on financial systems. So there are three key points in the evolution of core banking platforms. First, breaking up of monolithic platforms into microservices architecture. Second, migration of core banking platforms and microservices to cloud-based models that create banking as a service or banking as a platform. And then finally, integration of blockchain and DLT technologies in the backend and integration of smart contracts and decentralized finance ecosystems via APIs and the offering of DApps for customer-facing functions. So if you look at the diagram on the right, you have a traditional core banking platform offering, but the section in the red is basically your blockchain-based decentralized finance DApps ecosystem that is integrating into the customer data ledger and customer experiences. So my view is that essentially DeFi ecosystems via APIs and traditional banking giants are already under threat from neobanks and technology companies like Apple and Google, who acquired banking licenses and who have set up DApps rails to allow peer-to-peer payments and consumer-to-business payments via their own wallets. So Apple Pay, Google Pay. Deeper integration into the DeFi ecosystems by these incredibly cash-rich companies poses a real threat, as Gen Z will see them as an extension of their daily financial needs and not go to the traditional banking sector. So, effectively, if the core banking platforms are not able to integrate into the the new ecosystems and the tokenized assets, then it's unlikely that they're going to see the level of growth they have seen in the past 40, 50 years. So finally, thank you for joining me, and I will now open up for questions.
Well, thank you, Yagnesh, for the insightful presentation. And we have received several questions for sure from our audience. And let me allow to present some of them to you because, we are pretty short in our schedule and, well, as many as we can. So, what do
Sure.
you think? What do you think? So, the question number one. So, what do you think are the main challenges to make better flows? That are legal regulation barriers or technology ones?
I think both are actually quite important. So on the regulatory side, you have contradictions. So, for example, take uh, the U.S. federal government versus state federal government, where some state federal governments have now allowed ownership of Bitcoin through ETFs, but the federal government still does not want to take on that on a regulatory basis. And on a technology front, I think interoperability is going to be key and needs to be resolved. So, for example, if I have NFTs for the U.S. National Football League, American Football League, and I want to trade some of those NFTs for the National Basketball Association NFTs, I can't do that easily today, right? So interoperability will allow me to build a portfolio of different tokenized asset classes without worrying about, whilst they store value, how liquid are they?
Yeah, thank you. And I think maybe one question. Is there any room for P2P lending? It was popular at one time, but the credit risk was pretty hard to manage. And is there any chance it would be revived again in the future? Well, maybe with better technology.
Uh, in short, no, because peer-to-peer lending is very hard to regulate. Peer-to-peer lending isn't dependent on blockchain or any technology. I can lend a friend $10 today, and the risk is high. And what starts happening is when I start lending 30, $40,000 as a loan to a friend, and he uses it for things that he shouldn't be using, right? So there is the criminal element, there is the regulation element, there is the credit risk element, and it's nothing to do with technology as such. I think peer-to-peer lending, I would say one form of it could come up as microfinancing on blockchains,
Yeah,
but
thank
that
you.
would
Thank you,
be
Yignesh. Mhm.
to business or banks to business.
Yes, thanks. Well, this brings us to the end of our today's session. And thank you, Yagnesh, for your enlightening talk and for addressing the audience's questions. And we trust that everyone found this session session beneficial.
I hope so, and thank you for having me today. Thank you all.
Yep. Yeah. Well, and thank you to our audience for tuning in. Your questions will not remain unanswered. Believe in that. And up to next, we have exploring the role of tokenization in enhancing human trust. Sounds intriguing, doesn't it? And I'm sure you won't want to miss that. We will return shortly. Stay with us.